Is now JoAnne Feeney, Advisors Capital Management Partner and Portfolio Manager. You're just trying to summarize, and I'll let you speak, JoAnne. I don't want to speak for you, but I don't think you think it's the end of the world, although for the markets or for growth, but you think people need to be more selective at this point because, I mean, it's as plain as the nose on our face that there's some policies that could be perhaps some headwinds for the market.
Yeah, good morning, Joe. Happy St. Pat's. I think it's pretty clear that investors have been repositioning a little bit over the last few months. Clearly, we've seen valuations in tech come down as that diversification set of trades has really proceeded. And that shouldn't really surprise us. I mean, those stocks really moved quite a lot over the last couple of years, and investors found themselves really concentrated. And yes, at this point in time, we're seeing an elevation in risks. Actually, policy uncertainty has only been higher during COVID and during the great financial crisis in recent years. And so it's not surprising we're seeing some diversification trades happening here.
You took some growth off the table. I mean, what are we talking about? How much would you, in managing money, how much would you lighten up percentage-wise? What are you talking about? How bearish or how neutral did you get?
Yeah, you know, it really depends on the strategy, Joe. I mean, we're long-term investors, right? We look for companies that are high quality, that we think either have strong secular drivers or produce income for clients that we think will persist even during economic volatility. And so back in January, we took, for example, in our balance strategy, which is designed to be a bit more conservative, you know, we took some of the positions a little bit lower in some of our technology stocks. We didn't reduce the targets drastically, but our clients had become very overweight in those positions, and we wanted to bring those down and then move some of their funds over to companies we thought would be more resilient, even in the face of potentially higher tariffs or in an economic slowdown. Those tariffs are a real headwind, some for industries more than others. But ultimately, what we're watching now is how much tariff actually comes into play, because that could affect the entire investing backdrop. And so we want to be positioned for that for our clients, potentially who just want income, and we can go places that are more resilient in the face of tariffs.
Do you think it's become clear that anyone who just hoped that none of the tariffs would be put on because maybe some negotiations would prevent that? I think the market last week, there was a realization that some are coming on April 2nd. There's just no doubt that the reciprocal ones are coming out. Now, whether that's justified or not, it's still going to have an economic effect.
Yeah, I think that reality is sinking in a little bit. I mean, certainly the tariffs on aluminum and steel are in place, and we're seeing retaliation. You know, what level of tariffs we see come April 2nd is still an open question. And clearly what the administration wants is the threat of those tariffs to lead our trading partners to reduce their tariffs. We haven't seen that play out in history, whether it was the 2018 tariffs or way back to the Smoot-Hawley tariffs. We've seen countries retaliate. And that's where a lot of the economic pain comes in, particularly for our exporters. And then at the consumer level, obviously those tariffs will raise prices. We just don't know how big they're going to be. But that's the thing to watch. And, so back to your original question, you still want to own companies that have real solid growth.
Give us some. You could give us, I see 12 here that you could rattle off.
I won't go through all of them, Joe. I'll give you an example. Okay, we're a secular growth. We're seeing AI. It's going to spread. It's an enabling technology. It's fundamental, and it's going to change how a lot of work is done in industry. So companies like NVIDIA, which has gotten particularly cheap relative to its growth, or Broadcom, which we've owned for 10 years for clients, these are places to stay, even in the midst of volatility. It doesn't mean we're predicting they're not going to go down. They could, again, be a long-term investor. But if you want to build some protection into your portfolio, if you want to secure some income, get those dividend payments to help ride out the volatility, you can go to a company like, Kinder Morgan. Go where demand is inelastic, a Philip Morris or an Altria, or go where a company can be resilient in the face of a downturn. Company like TJ Maxx or even McDonald's. They bring in both income, but also a little bit less stock volatility.
Yeah, you almost got them all. TJX, Johnson & Johnson, Duke Energy, I guess. You like
Sure,
all those.
that good income there, pretty resilient, right? And also stocks that really got hurt over the last couple of years because of high interest rates. A company like AbbVie, Johnson & Johnson, these are companies that the demographics are playing to. Aging population, money in the pockets of the baby boomers for something like Botox.
I know you said a lot of your clients have gotten really overweight. I don't know, you're recommending McDonald's. Did you hear her say that?
Ozempic?
Yeah, maybe Eli Lilly for those clients that are, picking out.
Yeah, you have to watch the valuation on some of these, and obviously new competition coming in that space makes us a little bit wary of those high flyers.
Okay.
But
JoAnne,
ultimately, Ozempic's unlikely to affect very much the clients that go to McDonald's or the folks that shop at TJ Maxx or McDonald's. So.